Good afternoon, ladies and gentlemen. This is Robert Rayburn here at LifePro Asset Management. And I personally just want to thank everyone for taking the time to tune in this week. We have a lot to talk about. There's certainly a lot of concerns right now as it relates to government shutdowns and the debt ceiling debate in DC. Of course, a lot of political noise that can distract us from what really matters in the stock market and what really matters as it relates to our long-term investment goals. So we're going to go through all of that today, what matters, what doesn't matter, and some of the broad long-term shifts that are starting to take place in the stock market now that the noise of COVID is beginning to subside. So I'm going to go ahead and I'm going to share my screen as I do here every week. And this week, we are calling the presentation the shifting tide, because yes, the market was down in September, and this week was pretty volatile, to say the least. But underneath the hood, underneath the surface of the stock market, we started to see things that are starting to recover. There's certain areas within the market that, while the broader market is down, are actually beginning to rise in price. And we're going to go through that in our performance update as well. So some of the key takeaways from this week's update are: we see stock market leadership starting to shift away from those generational secular technology names that we've loved for many years, but sold earlier in the year. We're starting to see the second leg of that sell-off take place. And most of that money, for the at least here over the last few weeks, has started to shift into energy, the banks, industrials, consumer in certain areas. So we want to continue to see that reiterate. We want to continue to see that sustained, is what I should say, in October, November, and of course, to close out December. B, we're expecting the fourth quarter economic recovery to push interest rates higher. 2, we do expect an economic recovery to reaccelerate here in the fourth quarter, and that should be good for bank stocks. Rising rates tends to widen net interest margins for the big banks across the US, assuming that the short-term rates stay anchored at a low level. And then 3, or C, I should say, oil supplies continue to tighten. That is a positive for energy stocks. And not only are supplies tightening, but demand is going up. So demand is going in the right direction. Supply continues to be slow to respond. We're even seeing trouble out of OPEC now to actually meet their production quotas. So all of these are positive developments for the areas of the market that we're invested in. Now, one of the things that we want to do is we want to give an update in terms of some of the trades and adjustments that we're making in the portfolio week to week. So this week, we increased our weight in Ford, Devon Energy, ELG, Synchrony Financial, and JP Morgan, while trimming our weights, again, not outright sales, but trimming our weights in Halliburton, Schlumberger, Cleveland Cliffs, and Freeport. We did sell Coinbase and then trim back our Ethereum weight. What are we trying to do here? Notice that all of these are either just weight adjustments or just slight adds or slight trims. Well, what are we actually trying to do? Within energy, we're trying to gear more toward the producers and decreasing our weight a little bit toward the service companies. Why? Because we're really positive on the price of oil between now and the end of the year. So the companies that are going to benefit the most, in other words, directly, are going to be those actual producers with drill bits in the ground and taking oil out of the ground today. So that's why we've made that slight shift toward E&P and away from the service space. 2, we want to be in traditional banks. Net interest margins are going to start really expanding here as rates go to 1.5% and back toward 2%. We do think that 10-year interest rate is going to 2%. That will be very, very good for the banks, especially since the Fed remains on the sidelines as it relates to higher interest rates for at least the next 12 months. So that should widen out net interest margins. And we like the old established automakers over the disruptors such as Tesla. Not that we like the cars better, we just like the stock better. Why? Ford's going all in on electric right now. And we think a lot of these established players are starting to play catch up, and the valuations were there. We're talking PE ratios that are far below the stock market itself. So that's where we are kind of gearing the portfolio here over the last week or so. Now, as we close out September, we want to do a quick performance update here. So 2021, we're still down about 11%. Now, that's we were making a lot of progress here. We still have a lot of work to do. But if we look at that since inception number, we're back up toward 200% since inception, 97% ahead of the market after fees. Now, where has the progress really been made? If we look at the month of September, the stock market, the S&P 500 was down 4.76%. Our strategy was up 5.88%. And since the August 19th lows, our strategy is up 13.38%, while the stock market, the S&P 500, is down 2.23%. And even this week was an ugly week for the market. The market was down 3.32%, while the tactical opportunity strategy was up 1.72%. Now we still have one more day to go, see what happens tomorrow on Friday, but this is as of Thursday's close. So what's causing that? Falling COVID cases, rising interest rates, and improved economic confidence. The thing that really dragged down our performance here so far in 2021 was the rising COVID cases as we were transitioning that portfolio. So the timing kind of was suboptimal, but now that COVID cases are declining, the market is refocusing on the dominant strategy shifts that are taking place away from technology and toward energy, materials, banks, consumer stocks. And that's where we're in. And that's why we're benefiting so far here over the last 6 weeks. We saw this today. The world needs oil. Years of negligence, years of not investing capital funds into the ground are leading to energy shortfalls across the world. And that's where our firms that we're invested in can really benefit. We see today that China ordered all of their energy firms to secure supplies at all costs. We saw an immediate spike in the price of oil. Now, the broader market was pretty weak today, so we were down less in the market, but nevertheless, over the last week, we've seen that performance continue to accelerate for those individual energy names. And we think we're very, very well positioned here. We think this is early innings. We can't catch up in terms of supply, in terms of the amount of oil being supplied into the market overnight. The other big theme is this big generational shift that we think is taking place. Now, why did we make such a dramatic move in February, March, April, away from technology and toward the banks, energy stocks, industrials, consumer stocks? It's because of what's been taking place here in terms of the volatility adjustments underneath the market. So when we look at 2-day percentage change of the Russell 1000 Value Index relative to the Russell 1000 Growth Index, what we see is when generational shifts take place, we get these clusters of volatility over a short period of time. This happened in the late 90s. This happened in 2008, and it's happening today. In the late 90s, it was a shift away from growth and toward value. And we had close to a 7-year run where value outperformed growth. And then 2008 marked the shift of value to growth. And as for those clients that have been invested with us for many years, we've benefited from this. But this is what we noticed here recently, another cluster of volatility in terms of the relationship between growth and value. This is symbolizing, when we combine it with the fundamentals that we've all talked about in oil, the banks, industrials, et cetera, this is symbolizing another shift away from growth and toward value. And we think that is where the outperformance is going to be obtained over the next few years. And that's why we're positioning the portfolio the way we are. So what happens during reflation cycles? So the bond market tends to trade in these 30-year cycles. So we see here from 1954 to 1981, we were in a secular upshift or uptick in interest rates. So interest rates started to increase in 1954 and ran all the way up until 1981. Then we had a downshift for the last 35 years since the early 80s. What was the defining investment theme in both of those shifts? When rates were rising, value leads. When rates are falling, growth leads. We think, now this is, remember, this is the pandemic. So we kind of have to erase this pandemic impact. We think that we're now at the start of a new interest rate increase cycle. And if that's the case, we think value is very well positioned to outperform versus growth. So when interest rates move up, growth distribution expands across the market. It's not centered in just one or two sectors. And that means value tends to outperform growth. And that's why we're shifting the portfolio and why we've seen outperformance of the strategy over the last 6 weeks as rates bottomed out, as COVID cases started to drop down. So as rates started to bottom and rise, I should say. And of course, we're cautious on technology, ladies and gentlemen. As rates rise, we do see speculative growth stocks continue to sell off. For those of you who own some high multiple tech names, you know that September was a rough month. And what we can see here is, again, we've been following the NASDAQ 100 back in 2000 and overlaid that to the ARK funds today. It's continuing to follow that pattern. We are advising our clients for any of their outside monies, be very careful with technology. We think there is significant downside from these levels, and it's certainly an area that we are avoiding. Now, we do see the shadow rotation taking place. So despite the weakness in the stock market, let's take a look at a couple charts here. So first, we have the cyclicals relative to the defensives. We've seen a very sharp swing here in terms of the relative performance over the last few weeks. And this coincides perfectly with the swing upward in the 10-year interest rate. We think this is a sustained move, not a head fake. Second, the Russell 2000, which are small caps, relative to the NASDAQ. What we can see here, 10-year yield shifts upward, and then small caps relative to the NASDAQ also shift upward as well. Remember, we like to look at different symptoms, and we want all of them to say the same message. So the more the number, so as the number of indicators that say the same thing increases, the level of our confidence in our forecast increases as well. So then let's look at within that cyclical leadership, within that small cap leadership, who's leading? What are the sectors that are leading the charge within that leadership group? We see here energy relative to the NASDAQ. Remember, we rotated out of the NASDAQ and into energy. So this is an important chart for us. So we look at energy relative to the NASDAQ spiking upward here as energy reasserts leadership. Then we look at the banks relative to the NASDAQ. And again, we can see that resumed leadership starting to take hold. In the credit markets, this is high yield credit, the level of implied credit risk that's priced into the market. We can see, again, a very tame situation right now. And that's what we want to see. We don't see anything in terms of the credit markets getting bottlenecked or anything like that, especially with the whole debt ceiling debate. So what is the bottom line message here as we end the month of September? Despite the noise of shutdowns and debt ceilings, and I got to say the debt ceiling is one of the craziest debates that I think we have in this country, because every few years we have the same debate. Despite all that noise, we continue to see stock market leadership shifting toward those reopen winners. And that's the key message here. Don't get distracted by the news, by cable media outlets about the end of the world. We have to stay focused on our investment process, stay focused on companies that are good, getting better, and don't get distracted by this noise. It doesn't do anything other than lose you money over the long term. So three big themes here. The shift to value may last years, not months. That's why we're being very disciplined around the current stocks that we own. 2, energy and financials appear to be leading that shift within the growth to value theme. And then lastly, we do appear to be in the early innings of this technology unwind. Obviously, if it got to be very severe, we would start to pick away at some really good companies that would be cheap in price, but we're not even close to entertaining that option yet. But overall, we like where the market is. The market's going to continue to be a little bit choppy here over the next week or two. It is October after all. But despite that, the leadership is shifting underneath the surface, and we think we can make money despite volatility in the market. And as we get into the meat of Q4 and into November and December, we think that the market is going to resume its upward move. So overall, we're very positive. We like the way things are moving here in the market. We like where we are positioned. We're very optimistic in terms of our positioning. And if anyone has any questions or concerns, please feel free to reach out to your advisor, and they will be glad to set up a meeting where we can discuss the portfolio and some of the shifts taking place. So thank you again, and have a fantastic weekend.